Hi everyone, thank you for joining today's webinar, Seeking Alpha in Alternative Data. As always, this webinar is being recorded and will be made available to view tomorrow. Today's speaker is Anthony Ng. Anthony has been teaching investment and portfolio management related module-sat educational institutions since 2010. He holds an MBA and an MFE from Otago University in New Zealand and NUS in Singapore, respectively. With a strong passion for finance, data science, and programming, Anthony has also designed curriculums for his own beginner-level algorithmic trading workshops in addition to Quantopian events. Thanks, Anthony.
Thank you. Welcome, everyone. Just before we start, just want to get some housekeeping matters out of the way. So if you have a look at your chat, the usual question is that would you actually share your slides? You'll be glad that if the link that I've just sent to you, you can actually look at the slides as I'm speaking right now. Later on, I will provide you with the link on the codes that I used for this alternative data discovery as well. The notebook, the algo, which is the back tester, as well as the PyFolio will also be shared as well. But also, we'll be sharing with you the YouTube link whereby I recorded this tutorial videos on all of what I've actually shared. It's about an hour and a half long, so you can actually go back to it, so you don't have to fear that you'll miss out on any of these in case you want to go back to have a visit. Right, so before we actually get started, what I might do, and would love you to actually participate, is just go to this slide whereby the question is, prior to this seminar, how familiar are you with alternative data? So just to get a temperature, I'll give you a couple of seconds to try it out and see if you can actually answer the question, and just to actually see where is the interest and also your familiarity with it. So you want to give it a go? Good, it's starting to move. That's always a good sign. That means you can hear me. Excellent. So while you guys are actually filling in that questionnaire, I'll just actually walk through quickly the contents that I'll be sharing. The first thing is, why should I care? All right, so I'll go through that couple of slides on the participants or the players in this marketplace and some of the investment banks that has come out and publishing their so-called research findings, so that you can actually have a gauge of it, how important this part is, and they all come out to show that they are the thought leaders in this space. And the second part is that I'll go through what is alternative data, just to explain to you what we mean by alternative data. The third thing is, how do we access this data? And the fourth part here is really to show me how you do this, show me how you can actually extract alpha out of the alternative data set. And after that, where to from here? And the last one is really a quick background about me, so that you can actually look me up if you want to. So let's go back and have a look at the poll. And of course, this poll will stay open until a little later when we actually pose up the second question. So that's actually an interesting results there. So a few experts, a few intermediates. So it's about a good balance here. So let's start with, why should I care? Now, the term alternative data start to actually appear more and more in the financial services or the finance space, in particular investment space, started from about midway through last year. Goldman Sachs Asset Management came out and started talking about big data. Now, you probably will remember the big wave on big data over the last 2-3 years. And of course, with big data, you need to figure out how to make use of that. So that's where the alternative data start coming in. Now, you can, with all of these slides, there is actually, with the picture, you can actually click onto it. And I've actually embedded the hyperlink so that you can actually read the actual background research yourself, so that you can actually familiarize yourself with their point of view. This for you to actually referred to it. So that's part of the purpose of all these slides, so that it's tractable as well. Don't just listen to what Anthony say, have a listen to what others say as well. Okay, I think it's safe to say that finance, especially in the area of trading and investment, it's always about information. Where can you get the information edge, and how can you actually outbeat or outperform others, just usually purely by information alone. So not surprisingly, alternative data has become the actual, I guess, in a bubble in a sense, but it's one that probably will carry on for quite some time, because at the end of the day, it's always about the edge that we're trying to extract here. So in March 2017, not to be outdone by Goldman Sachs, Citi came out with, again, new alternative data sets. Again, you can actually, this one, unfortunately, I don't have the link, but you can Google, you probably will find it quite easily. Who cares? And big data and practice. And then along came JP Morgan in May 2017. They published this 280 pages, massive documents on big data as well as AI strategies. One of the things about big data is that it's massive, it's really fast, and velocity is not only velocity, but also volume. So we have to actually look at it from another way. How do we actually process this data and actually extract some useful signal out of it? That's where the AI strategy parts come in. And so this report that came up by JP Morgan doesn't just talk about big data and alternative data. They also talked about the whole machine learning tool sets that help you, or you can use to extract signal out of these alternative data. The last part is the alternative data handbook. That's where they give a directories. In fact, that fill 100 over pages of directories where you can actually look up all the different alternative data vendors. Of course, the next come Jefferies. They talk about data science in the hedge fund industry and how to actually make use of this. And after Jefferies, you have Barclays in June 2017, and then followed by Quant, and they talk about the power of sentiment and how to track movements in terms of the trade finance space. And after that is Ego Alpha. In fact, Ego Alpha is probably one of the earlier players. This is their third editions of alternative data. They provide 30 use cases of alternative data. It's a really good read. I highly encourage you. Again, there is the link for you to actually click onto it and open up and see how they actually make use of these data. Now, a lot of these data are institutional data, and it's actually quite expensive. I'll come back to it so that you can actually have a look at it and see how you can make the most of it, or gain access to some of these data. So we talked about a lot about why should you care and who has been using it, who came out to, showed you how you can actually use it. What exactly is alternative data? Now, let me give you a couple of definitions. The first one we always go to is Wikipedia. Wikipedia explained that alternative data is data that provides unique and timely insight. So unique here basically means that it's not something that you can get from normal market data or financial reports or SEC filing. And the other thing is the timeliness of it. So the timeliness of it means that it comes steadily and all the time. Unlike financial report, quite often it's 3 to 6 months delayed. It's usually, well, it's almost always historical information that you're obtaining. Even if they come out and the press release and come out with AGM and EGM, it's still delayed data. And the other thing about alternative data is it's really, really big data. Quite often it is crowdsourced. You look at financial transactions. The financial transaction here means POS data, or FPOS, or point of sales data. You have sensors, the IoT, mobile devices, where users or consumers make use of their mobile devices, and from there, through your searches or how you interact with your apps, all of your so-called information is gathered, your purchasing information, how you actually search, how you actually interact with your social media, all of these are aggregated and unsold. Of course, there are satellite imageries as well. There are public records. There's also web scraping for information. Quite often, these are what's called exhaust data, meaning it's not a direct consequence of your action. Now, take for example, the direct data would be an example of you going shopping in Amazon. You might have bought, let's just say, a webcam. Now, all of that, the exhaust is a couple of things such as how many people have bought this, did you rate this, and your location. All of these so-called sundries information that comes with it is called the exhaust. Now, these are naturally non-traditional data, such as your open, high, low, close volume. It's not investor presentation, nor is it SEC filing or press releases. This is from the JP Morgan definitions. They classify them into three main categories. You have the individual, you have the businesses, and then you have the government agencies or the censors, sorry. So under individuals, you have your social media, how you interact with Facebook, social, Twitters, and the likes, and Instagram. That, of course, will generate your likes and dislikes, your preferences, and what is the trending. Right now, obviously, what's trending is Bitcoin. The news and also reviews. The news, obviously, is quite tricky nowadays because of false news. Then you have the reviews, people interacting with the so-called providing reviews or ratings of be it books or be it the travel or accommodations that they have. So from there, you can actually also gather information about how popular either the store is or how popular is that business. So a lot of these are information, embedded information in there that actually can further down, trickle down into the balance sheet of the company. Of course, there is the web searches. It's been proven that you can actually use Google search to actually predict price movement as well, and also personal data. Now, business processes here covers both the corporates as well as the government agency data. Now, business obviously have transactional data such as your supply chain movement, your trade movement, and also stock movement. And then you have your corporate data, which is the internal one, and finally, what government agencies publish, such as your non-farm payroll, and the likes. So the third one here is the census. This is probably the one that actually has the most voluminous data that's coming through. You have the satellite imageries and the geolocation that comes with it and other sensors. Now, satellite imageries has been known to be used over the last 2-3 years to predict the stock, the crop yield, for example, and also trade data that comes with it. Tracking, for example, container, tracking, for example, the oil tank, whether it's actually full or otherwise, and tracking crop yields, what is it like, and things like that. So these are obviously embedded information in there that can help you to predict in some way some of the economic activities. Of course, you can also use this to take snapshots or look at how electricities are used as well to get some bearings on the economic activities. So what are the actual alternative data definition from another sources, such as Quinlan Associates? Their definition is this: alternative data, it's put simply, is any information that is non-market data. So basically nothing to do with your open, high, low, close. Any such usable information or data that is not from a financial statement or reports can be classified as alternative data. So that's really the long and short of it. Okay, what then is the benefit of alternative data? I talked a lot about the publications. I talked a lot about what is alternative data. Let's look at some of the benefits of alternative data. Now, again, these two slides are from Quinlan. I probably won't dwell on this very long because I want to get on with the codes itself. Now, comparing alternative data versus traditional data, alternative data is frequently updated. Quite often, it's quite high frequency. The only problem with it is that we don't have a long history. It covers many areas, that's why it's very wide. The only thing about it is that because of the breadth of coverage, it has profound implications on many assets. The likes of Twitter, stock tweets has been used to mine sentiment, not just from the products, but also from the companies. Obviously, you can locate Bitcoins and things like that as well. And you can actually gain competitive edge, but there is a catch. Obviously, these data come in fast and also very voluminous. So it requires a different way of processing it. Now, typically what a financial analyst is used to is getting financial reports once every 3 months. Whereas these data comes in gigabytes in any given time. So we need to actually use different tool sets to actually extract useful information out of it. So comparing this to traditional data, it's sparsely updated, it has long history, that's the good part, but it's very narrow. The inside of it, it's only provide particular information. Usually these are curated information and also portrayed in such a way that portrayed in a specific way that the company wants you to see. And of course, it is available to all. So it's very difficult to extract any useful information out of it because everyone else have the same information. And you can incorporate alternative data into these different areas, from idea generation to asset evaluation to portfolio construction and finally portfolio management. Now, the alternative data here is can be either generated by government or individuals. It covers the whole economy and all industries itself. So this is really the idea generation part. And because it's often generated by third party, the information is quite often unbiased. And it provides better prediction on upcoming trends and often lead to better investment insight. So with that, I'm going to move on to the next part now, which is how do we access this data? Q, of course. Now, this is obviously by no means the only source of data, source of access to alternative data, but it is a good place to start, especially if you are not familiar with alternative data. This is a great place because quite often it's curated. In fact, it is curated and it's actually tidied up in such a way that you can make use of it very quickly. What is available in the Q Premium Alternative Data Set? Some of these are free, some are not. Most of them are actually, there comes with it a subscription cost, but most of these have historical data that you can actually make use of. Okay, so that means that you might not have access over the last month, some of them over the last 2 years, but typically you can go back as far back as you like, well, basically with what the data is available, and make use of it for your own backtesting. So you have the Q Pipeline Data Bundle, you have the Event Vesta, sorry, there's a spelling error there. Within here is all the so-called earnings release, dividends, impaired charges, so I'll list out all of these for you to actually access so that you know what's available in there. You have Estimize. Estimize is crowdsourced apps or company whereby they actually use the crowd to source the earning estimates of a company. And they themselves actually have published the findings. Quite often is actually better than the analysts themselves. And then you have Alpha Vertex. This is a machine learning based prediction. So you can actually use this. The only difficulty or challenge with this is that it is a black box, so you can't really tell how they actually make use of this. Whereby Estimize is a bit easier because you know that it's actually based on competition that they run, whereby people actually contribute to their so-called estimate of what the company's earning is. So you can actually track that. But whereby Alpha Vertex, you don't know how they actually built their machine learning, so it's difficult to actually understand. So it's really a black box in that sense. Syntax is really a sentiment analysis. It's really useful. It's one that I do have codes for it, but I won't be talking about them. I believe if you look up the Syntax YouTube, they actually have some examples of how you can actually make use of their sentiment analysis. Zex here provide broker rating, some of the revision, and also earning surprises as well. And the last one is the one that I will actually be dwelling on, and I'll use this as an example, is Psych Signal, whereby they actually provide 4 sets of data. The beauty of Psych Signal is that it's free. You can actually make use of this. I think it was free for 1 year. I'm not too sure they have stopped or not. They provide data on Twitter and also stock tweets. There are 4 categories. It provides all views, no retweets, and one with all the views with retweets, and then Twitter as well as stock tweets, one with retweet, one is without retweet. Now, where else, if you want to move beyond the Quantopian platform, where else can you actually access this data? Now, this is from alternative datasets. You can actually click this link. I have hyperlinked this. It broken down into web data. You have credit card, email receipt, web traffic, geolocation, and satellite. So these are all the different players in this space and the providers. You have the sentiment. Some of the more famous names, such as Ravenpack, I talked about Estimize as well. There's actually iCentium that is featured in some of the publications I talked about earlier, and also a few others. And then you have others here, which extract, receipt, and a few other things as well. Ego Alpha is one of the publication I mentioned earlier. They are actually quite a good company to follow. They also provide consultancy. They published the 30 case study that I mentioned before, so it's probably a good place. If you're not familiar with alternative data, that's a really good place to actually get started, to actually get a handle on it. Of course, Quanto is here as well. They also have a website for you to subscribe to for alternative data. Okay, right. How do we make use of these data? Now, this is a sentiment trading example that I've designed and devised. Earlier, when I actually tried the MB viewer, for some reason their server is not working. You can actually come to this slide yourself and open up these 3 Git link. And the first one here, it goes to the research notebook. So in here is the code that I use, starting from the importing of the basic libraries. Okay, so you have the pandas, the blaze, and the trading calendar, and also this line of codes here is actually importing the data from Psych Signal. In particular, we are interested in the stock tweets. So if you look at the different views that's available, you have source, symbol, the bullish intensity, and also the bearish intensity, bull minus bear, and on it goes. So this is what it looks like. You have the source, which is from stock tweets. You have the symbols, AA, and it tells you the bullish intensity, the bearish intensity, and then the bull minus bear, which is this minus this. And then you have the bull score, bear score, and also finally, I can't see the last one here, is the bull bear message ratio, meaning how many messages are there. Right. As with any exploratory data analysis, some of the things that we want to do is just to get an understanding and appreciation of what the data look like. Now, these are obviously sourced directly from Psych Signal, and what is provided here is that it's, in particular, what I'm looking at is the bull minus bear score. Rather than looking at just the bullish or the bearish, I want to look at the difference. So this is the first 5 value of what it looks like. And what I've done here is that I've extracted the bull minus bear into a panda series. So again, looking at the first 5 counts, observations, this is what you get here. And if you look at the describe, which is looking at how many data sets or how many rows of data do we have 10,001. You have the mean, which is 0.36. And I looked at the median as well. The median is 0, but the mean is 0.36. So the first thing that it tells you is that this is obviously not normally distributed, and is actually positively skewed. And if you look at the histogram chart, one of the things is that is to actually get an appreciation and understanding of how the data is distributed. The first observation you can see here is that most of the data actually congregates towards the positive side. And this is one of the research finding and publications. They also noticed that people tends to be more bullish than bearish about their company or the one they own, which makes sense, especially if you are the owner of the company. Quite often you only see the good side, and you tend to actually tweet about the positive or what's good about it. So the sentiment tends to veer towards the right. And right, so that's really what I want to actually get an understanding of that. Number 1 is that you need to understand the distribution, how it's distributed. Number 2 is that you want to actually get an appreciation of whether it is skewed to the right or where the center is, and also where the extremities are. Ultimately, what we're trying to do here is to actually try to extract the sentiment and incorporate it into our long-short strategies later. So the other thing we want to know, because later on what we're looking to do is construct a long-short portfolio. Of course, you can trade either on the long side or short side. It's totally up to you. But I want to see if there are actually any alpha signal in there. So hence that's the reason why I'm constructing a long-short portfolio. And the other thing is that because I want to have a balanced long-short portfolio. Of course, it's going to be balanced in terms of the dollar neutrality because it's designed that way. But what I want to also design in such a way is that I want to know and make sure that I have almost the equal number of stocks on the long side as well as the short side. Hence, I use the length here to actually figure out how many stocks are less than -2. So that gives me 386 companies. That's on the less than -2, which is on the bearish side. And more than 2.5 is the bullish side. It's 361. So that's roughly equal. So that will be the line in the sand whereby I draw where the actual so-called bullish and bearish are. So just to understand the data set a little bit more, I want to extract Apple, okay, all of the data sets that we have. What we actually extracted earlier is everything. So you have AA here, I think it's American Airlines, and the actual list actually goes on. There's more than 1,000 companies in there. But out of that, I just want to look at purely Apple so that I can get a feel of what is it like for the Apple stocks and just to actually get an appreciation of the data itself as well. So I extracted the CID, the SITD code, and I want to make sure that everything that I actually pull up is Apple. Peak here is basically a little bit like head and pandas, and it will show you the first 10 data. So you can see there, stock tweets, Apple, the bullish intensity, bearish, and also the bull minus bear. Right, the other thing that I want to look at is specific period. So here we're looking at all of the Apple stocks, as well as is actually from 2013, December 1st onwards. So this is the data that is extracted out of it. And I did a count on how many distinctive CID that is in the stock tweets. There's actually 9,228. Sorry, ignore what I said earlier. So it's 9,000 plus stocks in here. Okay, the next part then is I want to look at specific period. So we are extracting from December 2013 until December 2014. So 1 year of data, and we're pulling out just the Apple stock and as well as the 2014 only. Now, the next thing that we need to do is just play around with the Blaze and look at the pandas data frame that we've extracted. So these are the data we've got, and this is plotting the so-called bull minus bear for the 2014. Okay, so the x-axis is the year from 2014 January all the way to the December 2014, and this goes from the bullish all the way to bearish. Notice that it's not all the way up to 4 as before, or all the way to -4. So you can see that people tends to be a little bit more bullish for Apple, and you can see how it evolves over time. This is the bullish intensity at average around 1.7, it seems. And scrolling down, this is actually looking at the message ratio, how many messages we do see. That's coming from the bullish to bearish ratio, and you can see this massive spike here in January 2014. I can't remember what the event was anymore. The ratio is 12 times to 1 ratio in terms of the number of bull signals or bull messages versus the bear messages. And then there's another spike here. Okay, so this is a picture of all the scanned messages. That's the number of messages. 6,000 here and a spike here, almost 8,000. So that's really how voluminous the data is. On average, it fluctuates roughly around 1,000. Occasionally, you get a massive spike like this in one day. Okay, right. Having got all an understanding and appreciation of the actual data itself, what have we done so far? We play with the API. We extracted the data. We identified the column of data we want to look at. In this case, is bull minus bear. So that will be what we use going forward in designing our factor or our long short that goes into our long short model. So having an appreciation of that tells us that next thing we want to do is long short obviously is we want to actually segment our data to the so-called into quantiles, ideally more if it's possible, but later on as you find out, because the data are not it's not easily separated into deciles or 10 buckets. So in the end, I actually have to make some concession to go with it. Okay, so here we are defining our factor in the pipeline. There are other things that we're doing here as well. It's not just looking at the sentiment data. If you look at this this line of code here, I've imported the pipeline. So I've made use of the Morningstar or the Quantopian Q1500 US stocks, equities, and also the sentiment data. But on top of it, I've also imported event Vesta for the business days until next earnings, as well as business days since previous earnings. What this is doing is that we are trying to actually not trade those stocks that has earnings coming up or earnings that's been released. Obviously, those are very stock-specific news, and it's going to affect the actual stocks itself. So that's what we call a non-systematic risk. We're trying to segregate ourselves from that so that that doesn't have any impact on what we're really trying to track here or trade here, because we're trying to extract alpha specifically from the sentiment itself. So we want to actually try to isolate as many things as possible. You don't have to just isolate the so-called earnings event. There are all the other things that you can actually segregate as well. So feel free to play around with like AGM or any announcements and the likes. Okay, so so those are the things that you might want to actually consider filtering. Even non-farm payroll, all these things you might want to actually consider filtering them out. The reason that you want to filter those out is because you actually want to separate. Those are separate factors on their own. What you really want to study here is that is there any potency or in this sentiment data itself? Right, and the other thing that two other things. One is it an announced acquisition target? So is there any M&A activities to go with it? So that's also something that we want to filter out. If it is, obviously the stock's not going to move much. If someone has already offered a set price, there's going to be hardly any movement, and basically would dampen the volatility of the stocks. Even if there's any positive or negative sentiment that comes out, the stocks will not move much as well. So that's the one that we want to filter out as well. And also business day since previous events is the other thing that we want to filter out. So just walking through here, this is the filtering out the earnings events, and this is filtering out any so-called new information, and this is an announced acquisition target, and basically these are the universe of stocks that we want to actually trade. The squiggly line here is basically means that not. Okay, so that's actually not in Python. So within the pipeline, what we want as an output is the column name is sentiment, and the actual we are ranking the so-called sentiment factor, and we mask it by the universe, which is this portion here. All right, so the first thing that we try to do is just run the pipeline, and this is the actual output itself. You notice that the actual data it's quite rigid. It's not real data, so it will create a bit of a problem later on when we actually try to rank it with or put them into too many bins. Right. So before we come back to analyzing our factor, sorry, let's move on to analyzing our factors. We're going to make use of alpha lens. The first thing that we want to do is from the so-called result output, which is this one here, we want to actually look at how many stocks that is being extracted from running this pipeline for that 1 year. So we're looking at the unique. So level 1 here basically means this level. This is level 1. This is level 0. Level 0 is timestamp. Level 1 is actually the stock tickers. And unique here basically means that only basically creating a set. Okay, drop off any duplicates. Stored it in the assets. And if you look at the assets, there's 1,620 stocks in there. The next thing you want to do is get the pricing 1 year, or rather, we are 2014 December 1st. Okay, 1 month ahead, and also getting the opening price. opening price, so that we can actually see what it's like when we actually sell the stocks upon market open. So running the alpha lens and also creating the tear sheet itself, the factor is the sentiment, and we input pricing, which is the price that we extracted. I break it down into quantiles because there's a bit of difficulties in breaking it into too many buckets. And look ahead bias is 1 day, 5 day, 10 days, and 20 days ahead. And now looking at these statistics, couple of things you can see here is, let's look at the returns analysis. So if you look at the 1 day is 0.05, 5 days 0.02, 10 days also 0.02, and 20 day ahead is about 1.3%. The important part here is we want to look at the p-value. And you notice that this is significant. Anything that's less than 0.05 is significant, but the 5 days is not significant. The 10 and 20 days are both significant. And if you look at this, that means it's telling you that there are actually some significant alpha in here. How much is the alpha? If you look at it, the annualized alpha is 5.4%, 1.9%, and 1.3%. And if you look at the beta, it's actually almost zero. The highest number here is minus 0.03, so it's slightly on the negative side, but ultimately it's actually almost zero. The other thing is that you want to look at is the bit, the top quantile and the bottom quantile basis point, the spread. This part here is really 1.164 minus 0.771 gives you the basis point spread is actually 2.169. This, funny enough, is actually negative, so you might not want to trade those. All right, the turnover is actually on the high side. If you look at it, it's roughly 55% of your portfolio being turnover. This may be a bit of an issue when you actually want to implement it, especially in a small portfolio. Okay, so this is the picture that most of us do want to see. The lower quantile is deeply in the negative. The positive quantile is deeply in the positive. But there is some problem here with the 2, 5, and the 5, 10, and 20. Notice that it's not stepwise. What you really wanted to see is actually an increasing. What you want to see here is actually going, well, this whole portion in a negative territory. So looking at this, there are some alpha here for the 1 day. There's not much anything other than that. And we look at the volume pot to actually get an appreciation of roughly how the spread looks like. And if you look at this, it actually has a long tail. And this is part of the reason why you need a fairly large portfolio, because you need to make many bets, and some of them don't turn out. So you are trying to basically play an average games here, and to make sure that you actually extract as much as possible the mean here and here, the difference. Okay, this is the long short portfolio, so it's actually quite steady. This is for the long short portfolio, cumulative return 1 day looking forward. And this is also what you want to see here, is that you can see the red one is quantile, the bottom quantile, the 2 is the upper quantile, so you can see that they actually spread out well. The 5 day looks okay, but we also know looking at the scale is actually very, very small. Okay, right, and what else can we actually conclude from here? You can look at the 1 period forward return information coefficient. Is fairly steady, but it does actually dip below 0 a couple of times, and it tells you that it has worked well in the past, but it seems like it's slowly being upped away over time. And that's one of the things about alternative data, is that once it becomes well used, the actual alpha would have been extracted away over time as more and more people use it, unfortunately. Okay, so having looked at all that, the one last thing that I want to look at is the actual quantile turnover. The 20 period, if you look at this, it's actually, you do turn over the portfolio quite a fair bit. That's 70% of the actual portfolio itself. So that's a bit of a issue. These are some of the things to actually keep in mind. That's how you actually read that as well. So that's really the notebook. The next one is looking at the, before we go into the tear sheet, oh, well, let's go into the tear sheet. If you look at the tear sheet, it's not too dissimilar to what I looked at earlier. This is 2013. This is kind of like Alpha Lens, but we are running it forward now. If you look at this, the couple of key ratios, the Sharpe ratio is 1, volatility is on the low side, 7%. Annualized return is okay. Skew is good. Maximum drawdown only 3%, and it's a fairly stable time series, about 90%, which is also good. The gross leverage ratio is 2 because we're long one and short one concurrently. And the alpha is actually quite healthy at 0.15. And if you look at this, it generally looks quite okay, with the exception of the one thing that I mentioned before is the one is the decay of Sharpe ratio. That's one. Notice that it's not very correlated or to the actual common factor. I haven't run it on the new risk model yet. This is based on the old Pharma and French three-factor models. And underwater plot is quite decent, only 3% drawdown. Okay, so I'm going to leave that for you to actually play around with. I'm conscious of time as well. The last thing is the algorithm. Again, I won't run through these, but these are here for you to actually, well, you can copy and paste and run it in your algorithm as well, in your backtester as well. And last but not least is the YouTube. Let me just open this up. This is my personal YouTube. You can actually see the whole psych signal lessons here from 1 all the way to 6, where I have a bit more liberty in terms of time. This in itself is more than an hour and a half long, way longer than the actual webinar itself. Okay, where to from here? Couple of places as a start. I've these 1, 2, 3, 4. The first 4 links is really the Quantopian so-called suddenly lost the words here. What's it called again? The community. Sorry about that. Yeah, community. Some of them that's shared by Thomas and also Jonathan. You can actually use those to actually get started. If you are more adventurous, you can have a look at the Quanto alternative data. You can subscribe to them. And if you really want to actually get involved in the cutting edge stuff, you can actually go to, there is actually an alternative data conference coming up. So feel free. Actually, I'm going to update the link. It seems like the link has broken a little later. So with that, let's take another poll. Let's see. Okay. Do you have any plans? This is also my way to checking that I haven't actually hypnotized all of you. Do you have any plans to incorporate alternative data in your algorithm development? So give that a go. It'll be very informative for us to actually to see whether we can actually help along the way. I'm sure Quantopian will come up with more training. Thanks, I haven't convinced you. Awesome. I'm not going to look at that. I'll let you run that. And this is a little bit about me. You can actually find me and the various means, either via my LinkedIn or my blog. And what I'm going to do now is that I'm going to hand you back to the organizer to take questions. So that's really the end of my presentation. If you have any questions, feel free to actually post it on the chat, and we'll try to answer them as best as we can.
Yeah, so if anyone has any questions, please enter them in the chat, and we'll wait just a minute or two while those questions come in, and then Anthony will answer them.
All right, the first question is, will this data help to develop leading financial indicators? Yes, definitely. Especially when it comes to alternative data, a lot of the data will come in way ahead of the announcement. I know there are quite a few players in the marketplace actually make use of this data to predict what the GDP will likely to come in. the GDP or the labor or non-farm payroll, some of these market moving information, they do make use of those, but it won't be the normal financial indicators that you are used to, but it definitely will be something that actually will lead the market. You can obviously get a feeling of how the market or how company is performing by looking at some of these alternative data. I know for a fact some of these data has been used for the likes of the post data, the post transaction, the volume that comes through. That's one of them. The other one is actually the so-called the parking data, using satellite imagery to see whether a retail store is doing well or not. So there are plenty of examples out there. I highly encourage you to actually go back to some of the links that I shared earlier. The likes of Ego Alpha is very useful. They do provide a lot of examples that you can actually get started with, just to get some idea out of it. Some of these may not be available in the Quantopian platform. If you are brand new to this, it might pay to actually start playing around with the data that's in queue, just so that you're actually familiar, start off and be familiar with the actual data itself and how to make use of the data and what kind of useful information you can actually extract out of it before you go out there and start paying thousands, if not hundreds of thousands on the data itself. This is the Ego Alpha report. It's roughly about 30 pages. You can actually click here to download it yourself as well. So it's free for you to actually make use of. Have you seen web scraping data play a role in algo trading? Personally, I haven't. I haven't actually got around to doing that, although going back to the slide that I was sharing earlier, to be honest, a lot of these data, because they are so voluminous and quite difficult to get hold of, it's difficult to test everything. Okay, let's see. Go back to my slides. The web scraping is these ones. You can actually have a look at their website, all the way to YIPIT data. So this column here are all web scraping. I think web traffic as well, but typically the web data is the one that actually does a lot of web scraping for that. Hope I answered that question. Not sure if you can answer this, but curious whether you are trading yourself and if you have been profitable using alternative data. It's always that question. Always very interesting. Yes, is the straightforward answer. I find there are a lot more useful signal in alternative data than the market data. It's a lot more difficult using market data. All right. Okay. Quick question about IR values. Let me just have a look. Okay, it's this one. Let me close some of these. Yep, I think it's in the. Let me see if I can locate that. IR, yes, it's 3.7 for the 20 days. That's true. Okay, next question. If I detect an opportunity through using alternative data, what are the chances that others have not snatched that opportunity to trade? Aren't big companies always in an advantageous position to get the low-hanging fruits? I think, as in the beginning of my presentation, I already highlighted the fact that trading is always an information game. And I liked the theory that Andrew Lowell came up with, which is rather than efficient market hypothesis, is adaptive market hypothesis. And it's always an arms race. But the question, though, is that if you don't play this game, you don't actually get on and you make use of these data, you're going to be left with pretty much beta. If you're playing beta, then why spend so much time in doing a whole lot of research? Maybe the best way is to actually just by the ETF. I think one of the thing about alternative data is that you can actually do back testing. That's the first thing, to see if there are still any, whether it's still, whether it's still effective or not, whether it's still efficient or not. That's the first thing. Second thing is that even when you're running it forward, you still want to pay attention to the actual performance to see whether it actually deteriorates or not. So that is some of the key things to bear in mind. All right, the next question is, the alpha lens analysis showed that there was a lot more alpha for 1 day than 5, 10, or 20 days. Do you think that some of these stock tweet data is based on tweets after the market close, making trading on that information on the same day impossible? It must be hard to eliminate look-ahead bias completely in this kind of analysis. It's possible, but the one thing to bear in mind is that what I didn't actually highlight is with all of these data, it does actually have an as of date stamped to go with it. That's really the as of date. So that means you can only trade yesterday's tweets. You can't trade today tweets or tomorrow's tweet. So, well, of course, they try as best as they can to actually eliminate look-ahead bias. It's not always possible, of course, but as best as you can, using the Quantopian platform, this has been reduced to a minimal. I like this next question. This next question says, would you say there is more money to be made by trading with alternative data or by generating alternative data and selling it? I guess it's horses for courses. It depends. A lot of these things depends on your own personal competency. If you actually have the ability to source data, for example, especially in this raw form, and transform it into something useful, hey, by all means, go for it. That is actually running a business. Now, if you have, for example, a pool money that you also manage, of course, this has to be a fairly large amount of money in order to trade effectively, then yeah, alternative data also works. But again, the question comes down to there are a lot of obviously context that goes with it. So that part, it's important to keep in mind, is that yes, you can actually generating alternative data, but does it actually generate alpha? That's the first thing, and of course, selling it is it's running a business on its own. You're gonna incur a lot of overhead costs to go with it. But yeah, either or works. But there isn't a cookie cutter or straightforward answer to that question, because it really comes back down to your own resource and where you're actually good at. Okay, next question is, will machine learning techniques and the standardization of alternative data approaches, meaning everyone using specific sentiment signals, remove competition in the public investing industry? I think one of the impetus that we come to, I guess, the landscape that has changed over the years, in particular over the last few years, is that, number one, hedge fund industries find that they don't generate absolute returns as well as they used to. So that means competition has heated up substantially. So they need to actually find some way to justify the high fees and also the high watermark and also the performance fees that they actually extract out of the marketplace. So as a result, a lot of them has start venturing or move into this alternative data space to, again, the information edge, try to extract information edge out of it. This is always going to be a competition. There's no two ways about that. Whoever that can actually, number one, get all of the data, number two, make use of it, number three, put it into place. The execution is always the most important part. Machine learning techniques, depending on whether you have the talents or not, it's not an easy marketplace to actually find talents right now. And financial industry have to compete with Silicon Valley. In fact, most of the data scientists are attracted by Silicon Valley rather than work for the finance industries. You can actually see this quite obviously. Talents are really difficult to find. If you look at some of the players in the marketplace, such as Two Sigma, who runs competition, in the Kaggle data science competition, and the other one is Quant. They also run their own university. It shows you that there are just not a lot of talents out there that can actually make use of the machine learning techniques. Well, there's just not enough talents. That's first of all. Yes, there might be a lot of data scientists that know machine learning techniques, but is your data ready? That's also the key part about it, is that if your data is stored in CSV file or flat file or Excel here and there, all distributed, and you have no way to actually consolidate and actually have it roll out in a quickly and timely manner, it is also quite useless as well. So that's the part that to build up the whole infrastructure is easier said than done. Right. The next question is, what is the relation between alternative data and open, high-low, close data? Will alternative data be automatically built into open, high-low, close? If someone is looking at it and everyone is trading at it, then it will be reflected in the price itself. Otherwise, the likelihood of that reflecting the open, high-low, close is very low. The reason that you can actually generate signal all of this right now, especially for sentiment data of the last 10 years, is because very, very few people, number one, have the capabilities, number two, be able to actually implement it easily. And that's why typically these are usually locked up in the top 10 hedge funds or big fund houses who actually have the ability to do that. The next question is, are the rankings of funds that use these kind of alternative strategies publicly available, and how do they stack up versus traditional funds? It's a good question. I don't have access to that information. What I can say is that usually it's very difficult because I don't have a full picture view of who make use of these so-called fundamental methods. Some of the stars of the hedge fund industry, though, is very obvious. You have your 2 sigmas, which is very obvious. You have obviously quite a few, like Woquan is the other example. A lot of these, even those who are traditionally so-called fundamental traders, are starting to adopt the quant strategy simply because they see that there's not a lot of returns that you can extract out of purely trading market data anymore. So hence they actually make use of this as well. I mean, let's face it, before computer comes along, what is the technology that you have? It's really good analysts who go and knock on doors, go and talk to the company management, or even sit outside and monitor the number of trucks being delivered or moving in and out of the warehouse. And just by counting that, you can actually tell how much trading volume or volume of trades that's actually being generated. From that, you can actually, well, that's how they actually trade those information that day. So that's really the information edge that they have. And today, obviously, we have computers. We can sit in front of computers. A lot of these data are directly shipped to us that we can actually make use of. And that's really why it's getting more and more competitive. And those who have access to these data and this information obviously will win this game.
Okay, I think that's all the questions for today's webinar. Thank you, Anthony, for hosting a great presentation. Like we said, this webinar is being recorded, so please check your email in the following couple days, and you'll get a link to the webinar as well as information about our upcoming webinars. And great, everyone, have a great rest of your day.
Thank you. Goodbye.
Bye.